Yo, what's up guys? Welcome back to This Just In. Thank you for joining me today. In this video, we're going to talk about the Sofi stock. It's been beaten down pretty bad on their last earnings report. So I want to give you my thoughts on what I think about it, what I'm doing moving forward, and then I'll also give you my Sofi stock price prediction for the end of 2021. So let's jump right in. All right, guys, before we get started today, subscribe to the channel for me. Hit that little bell so you get notified every time I post. There's also a link down in the description to my Patreon account. Come over and join the family. We've got an awesome community over there. You'll get access to the private Discord where we talk stocks. You'll get links to all of the different portfolios I've got so you can see exactly what I invest into. And then anytime I buy or sell a stock, up to the second I do it, I send it out so you can follow along. I actually think the most valuable part of the Patreon is all of the swing trade setups that I send out. So anytime I'm mapping a chart, whether it's on crypto or stocks, looking to take a short-term swing trade, I put that on your radar. Same thing when I'm breaking down fundamentals, looking for high conviction plays or value plays. I send that out as well with all the snapshots of the income statement and things like that. So, and then I've got education over there, so it can help you take your investing to the next level. So if that's something you're interested in, come over and join us. I think you'll get a lot of value out of it. Day one squad, I love you guys. Thank you for your support. It means more to me than you will ever know. But guys, let's get started. Very similar to PaySafe's video yesterday, Sofi is one of my favorite stocks. For those of you guys that are new here, I have owned it since early SPAC days when it was IPOE, made many videos on it. Where I go much further in depth on the company and what they do and their products and services. So I will link that right here, if you want to check that out. Today, we're just going to talk about the earnings report, recent price action, what I, thought about the earnings and, what I'm doing moving forward. And then I will also give you my Sofi stock price prediction for the end of this year. So let's get started, guys. First thing we're going to look at today is earnings. Guys, they reported earnings back on August 12th in after hours, and Sofi stock price opened up the next day down like 22% in pre-market. That was mainly caused by a huge miss on their EPS. Guys, as you can see, they were expected to do about 6 cents, a loss of 6 cents, excuse me. And they ended up reporting a loss of 48 cents. So there was a huge miss there. The revenue was good. They reported 237.2 million, which was a 74% increase year over year, which was a beat by about 18.6 million, as you can see from right here. Guys, it's funny because I read the transcript, and in the transcript, they were explaining that there was a $144.3 million one-time charge that was added to their bottom line for the Galileo acquisition, okay? What's funny is those are non-cash items. They're literally paper losses, and so they just had to be recorded, and if you take that out, they actually did 5.8 cents loss. So it was right there in line, even slightly better than what they were supposed to do or guided to do, but everybody lost their mind and the stock sold off 20-something% in pre-market and after hours. Guys, that's like a huge thing. That's, the saying the market can remain irrational more than you can, remain solvent is very true. It's funny because you see a big, massive EPS gap down like that. And instead of investigating why that happened, people just dump the stocks. And that's, I talk a lot about the composite operator in the Patreon, and that's why, guys. For those of you guys that are not familiar with the composite operator theory, it's a theory that one man runs the whole market. Guys, when you see big capitulation like that, people just dumping their stocks, that's like, you got to look at it like that's what the market maker wants you to do so he can pick up your dirty, cheap shares because the earnings report really wasn't that bad. So like that was a perfect opportunity for you to do a little research and see why that EPS was so bad and then pick up their shares while it was down there at the bottom, down 22%. So just a thought, guys. It's pretty insane how something like that so minuscule can happen, which, is not a huge issue at all, but still the stock gets wrecked. But anyways, guys, let's move forward. Couple of things I wanted to show you here. So remember in the last video, we talked about members growth and how members growth needed to translate to multi-product member growth, because the sooner that they could build that multi-product member growth, the better. And that was one of the most crucial aspects, because it brought up their revenue per user. They already have a low customer acquisition cost, so that's an extremely key aspect to their business. Well, look at what they've done with their member growth. As you can see here, guys, they did about a 2.5 million members in Q2, and they did about 2.281 million in Q1. So they did 113% growth year over year. They did 110% growth year over year the previous quarter. So they're growing that member growth right about in line with the math we were doing in the previous video, which is fantastic to see, guys. This platform, Sofi, does a really good job at scaling those members. And by the end of the year, they're predicting to have about 3 million members. And I actually think they will do more than that. So a lot of upside there, guys, in members growth. Next thing here is their products. So again, multi-product memberships. Now, the way that they calculate this, they calculate products as just each individual service or product that they offer. Continue accelerating year-over-year growth in products, up 123% to 3.7 million products, plus 2 million year-over-year. So huge jump there in year-over-year growth. Obviously, they were coming from a really low year, in 2020 and 2019, but still, nonetheless, really nice growth there. Quarter-over-quarter growth still looks really nice, guys. Despite the negative EPS, their growth was still really, really nice, guys. So it's just funny that, they reported such a strong earnings report, but it was almost really deceptive. But most people will never know that. Galileo accounts reached 79 million accounts, which is 119% year-over-year growth. 100% year-over-year growth for the last 4 quarters, guys. That's big growth there. The reason why I love Sofi so much is because it's really hard to compare them to a lot of other stocks, right? Because they offer so many different products, which can be a negative thing, but it can also be a good thing, right? You don't want to spread yourself too thin, but they do a really good job at supplementing and putting all of these products together so they complement each other. Galileo is a big piece of their business, guys. This is one of the key things. Galileo and the bank charter are my 2 biggest reasons why I like the stock. Those are 2 very key aspects of the business. All right, guys, next thing I want to look at is the actual quarterly performance on the adjusted net revenue and the adjusted EBITDA. Like we saw when we were looking at the earnings just a minute ago, 74% growth year over year on the revenue, and then the adjusted EBITDA, guys. This is their 4th straight quarter of positive EBITDA. Very important there, guys. They, the sooner that they can, get to profitability, the better. But seeing that adjusted EBITDA has been, positive for 4 straight quarters in a row is very important. Big growth there year over year and quarter over quarter. Awesome to see. What's pretty insane about this earnings report, guys, is the growth was so strong despite their biggest revenue driver being really, really constricted. The federal moratorium on the student loans put a huge strain on the growth rate, guys. Student loan refinancing is a huge aspect of their business. That's what they started with when they originally, did the company. So showing, that big of growth was such a big constraint on one of your biggest rev drivers is very impressive, but they did a very good job at navigating it nonetheless. Guys, let me explain it this way. It's almost like, say the government comes out and they're like, all right, we are going to give out free, running shoes, athletic shoes, basketball shoes, whatever, free shoes for the next 2 years. And Nike was still able to grow their revenue at 74% year over year. That's what Sofi just did. There's some people, obviously, that if the government came out and said they're going to give you free shoes, that would still buy Nike shoes, right? But majority of people would probably wait. That wouldn't be the first thing on their mind. So that's I know that's not the greatest analogy, but guys, that's pretty much what Sofi just did. The government comes out, put a moratorium on the student loan refinancing or the student loan, debt, and SoFi still manages to navigate and post extremely strong growth. So it's just crazy how the earnings report at the EPS looked so bad, but when you really dig a little deeper, it really is very nice. I think the market got it super wrong, and that presents a very nice buying opportunity for us. So, all right, guys. So the next thing we'll look at, the annual adjusted net revenue. 852 million versus the and then the annual adjusted EBITDA of 61 million. So they're doing great, guys. I mean, they're growing just about what their their forward full year 2021 guidance looks like. What's pretty awesome is they didn't adjust their forward guidance despite the lengthening of the student loan moratorium. That is another reason why people sold off, because they didn't raise their guidance, even though their growth looks like they were going to beat guidance. But they extended that moratorium on student loans. It was supposed to end in like September, and they're not going to end it until January 31st of 2022. So they didn't raise their guidance. That's not a big deal, guys. That cost them like $40 million, in revenue for the rest of the year, but they still didn't change their guidance. You would think a company shows that they're going to lose $40 million, they're going to bring their guidance down, but they're confident enough that they're still going to hit their guidance, even though they were planning on getting that moratorium dropped sooner and getting that 40 million from that, student loan refinancing. So guys, they are doing everything that they need to do. Their growth is great. They're growing, they're expanding products. They're doing everything they need to. If we take a look at the next slide here, guys, this is the Q2 2021 gap versus their guidance. As you can see here, guys, the guidance on the low end was 215 to 220 million on the high end. For adjusted net revenue, they did 237 million, so they beat it by 10% on the low end and 8% on the high end. Adjusted, EBITDA, same type of thing, guys. 11.24 million on their guidance, on their actual, where they were only guided to do -8 million to 2 million. They blew that one out of the water, beat it by 8% on the low end and 4% on the high end. So really nice to see, guys. I love watching SoFi beat guidance quarter over quarter. There's so much coming for SoFi. Like, the management team is really good at executing. The bank charter's going to come. Like, there's a lot of upside here, guys. And the negative EPS does not bother me at all. The fact that they didn't raise their guidance doesn't bother me at all. Now, as far as the Q3 guidance, they're pretty much expecting to do about 245 million to 255 million. For the adjusted net revenue, and about anywhere from -7 million to -3 million on their adjusted net EBITDA. As you can see here, guys, expected continued strong growth with 245 to 255 of adjusted net revenue and -7 to 3 million of adjusted EBITDA, despite the fact that the moratorium on federal student loan payments is not ending on September 30th as originally anticipated. So that's big, guys. I mean, that's really big. $40 million is a lot of money for them to, be expecting and not get, and for them not to change their guidance is really important. And then real quick for the full year 2021 guidance, like we've looked at before in the investor presentation way back in January, they're predicting to do about 980 million for full year 2021. In adjusted net revenue, and then 266 million, which is contribution profit, and 27 million in adjusted EBITDA. I actually think they're going to beat those quite substantially. 8-10% would be huge, even if they beat it by 5% with everything that we just talked about. So, guys, the earnings, despite the freak out, despite the EPS drop, looks so strong. I have no problem with it. All it takes is just a little bit of digging to see that 48-cent miss was due to a paper loss. So last thing, guys, let's take a look at the chart. All right, guys, so the chart is still range bound, just like the last 4 or 5 times we've looked at it. The stock ran up pretty substantially right back here in January and February, just like all of the SPACs. But just like we talked about with the PaySafe video, the SPACs have been getting beat down unjustly. Now, one thing I want to point out that SoFi has done much differently than a lot of the other SPACs is this little rally right here in right at the middle of May. Guys, most of the SPACs, they found a low in March, and then they blew right past those mid-March lows into April and May, just bleeding out and making new, farther all-time lows. SoFi was able to create at least some type of sustained rally. This Gartley right here is what ushered in this, run back to the top of the range. It ran up and reached a high point of almost $25 before dumping back off. Now, this was right around the time that the ticker symbol was changing. But that little rally is really important, guys. It shows that there's enough market participants in SoFi to create, a sustained uptrend. One thing I'll say that's really important is the employee lockup period, happened right around their Q2 earnings report, just like a week or so ago. And 95% of the shares are now unlocked. So there's not any negative catalyst in the future for, expiry dates. So nobody has to worry about that. Look how much more volume you've got around this time. When you have that many shares flood the market, that puts a lot of downward pressure on a stock, guys. I mean, I don't think that's just, natural organic sell-off. That's, shares opening up, employers, taking profit. And so you get that, flood on the market of those shares. If that wouldn't have happened, you could have very well seen it, back test this level and keep moving back to the top of the range. Unfortunately, you didn't. One thing I want to say, guys, is look at what the stock was doing before that earnings report. That big momentum shift, you get down, you get that rounding bottom. That is a very big sign of seller exhaustion, guys. You're getting negative momentum waning. You're headed back up. You reach the bullish control zone, and then earnings came out and capitulation blew right through the levels. Guys, you still have one more crucial level at $13.10, as you can see here from the March low. I didn't like that it broke out of this little level right here, from a wick low down in May 13th, but you still could get to 1310 and be just fine. It wouldn't be weird at all. Now you break 1310, you're going to $10. That's when it gets scary. I don't think you'll do that. I however think that you're going to hold this level. You're going to come out and back test it, confirm it as support before, moving back up. Now, what you really need to do is break this supply line. Once you can get up here towards the top of the range, confirm one of these levels, you'll be in a lot better shape, because you could come up, get rejected, create that partial decline, which is a very bullish signal, and then blast right out of the top of the range and head into, price discovery and all-time highs. Now, that's a lot of ifs, right? But that's kind of what looking at charts is creating, assumptions on what's going to happen based off what the chart is telling us. I think everything looks pretty solid. I really like this rounding bottom right here. I really like the momentum shifting structure. I like that it was a steel wall, all the way through, March, February, April, May, those months that most of the other SPACs were getting wrecked. You don't see that a lot when you pull up a lot of, small SPAC growth stocks. Most of them are down way past their NAV price at $10. SoFi has managed to hold on. I think the market got it really wrong here, guys. I think that these areas will not be there for long, and I think this creates a really nice buying opportunity. One thing you have to realize is investing in SoFi is a volatile ride, right? Just like any of these other growth stocks, you're going to have volatility. So if you don't have a stomach for it, I would recommend not buying it. But if you, if you can handle it, these levels are absolutely the most low risk levels that you can possibly buy at. So if you already own it, look at your cost basis, find out where you're at, and kind of see if it's going to, change your cost basis significantly if you're much farther above that. Now, my cost basis is down around these levels. So again, just like PaySafe, I'm leaving it alone. If it, capitulates and falls down further, I'll then, kind of, regroup from there. But as of right now, these are the levels to make a purchase at. You could even technically say you've got some type of, bullish bat or some type of harmonic right here. But the big thing is just the double bottom, guys. I mean, one thing that I like is from the all-time low, back here on inception to the all-time high, you just made 78% retracement, and that 886 is right below that 1310 level. So you very well could see that 1224, but I don't think you'll get there. I think if anything, you'll hold support at 13, psychological resistance, 1310, the highs from back here in December. So you know, those 886s, those 786s are those levels where major reversals happen. Those are those deep value perceived areas that you want to buy stocks at. So now last thing before we finish up here, guys, based off of everything we just looked at, my price target for SoFi for the end of 2021 is still that $29 level, that $30 level. I absolutely think they will get there. I really still think that we're going to get one last, you know, rotation. We're going to, you know, towards the end of the year, we're going to get a lot of, you know, positive momentum, and you're going to see the stock really start moving to the upside. One thing that you could be looking for here, guys, is again, a, you know, inverse head and shoulders. You get the head to come down, you get the right shoulder to come up and back test it, which would create hidden bullish divergence, and you're running back to the top of the range. So keep an eye on it, guys. I love SoFi, have no problem with the last earnings report, actually thinks it looks amazing. But this video is for entertainment purposes only. I'm not a licensed stockbroker. Always do your own research and due diligence. Don't just take my word for it. But I'll see you guys in the next one. Come join us at the Patreon. I love you. Peace.